Good morning, Mrs. Kiss. Rather chilly this morning. I was just saying that to the students as well. But anyway, we are going to look at question 3. And like I've said off air before we actually started the recording, we are going to teach you how to do this in practice, but also we are going to hopefully give you a few exam hints or a few techniques that you can employ in a test or exam situation. So you can find question 3 in that cash flows question bank. You know where it is. It is under content general. We spoke about that and illustrated that last week. So it is the same question. I've just adjusted it slightly, ladies and gentlemen, just to make the layout a little bit more readable. So it is not identical, but there's no figures that have changed from the one in your question bank. I've just adjusted some of the descriptions slightly. So I think we've said this on a few occasions already. Normally, when it comes to a good exam technique, is to go and look at what is required of you first. So here we see we've got a statement of financial position, um, and then we've got some additional information that we'll have a look at. We see there's an extract from the statement of comprehensive income. But anyway, I think it's now, there's also an extract of the statement of changes in equity, but I don't think it's any mystery what is going to be required of us. So two things basically, we've spoken about this last week, Wednesday, the statement of cash flows for the year ended 30th of September 2020, and the note to reconcile the net profit before tax with cash generated from operations. Now, you remember last week we said that in financial accounting 2, it is a good idea to do that note first, that reconciliation note, because that provides you with a figure for cash generated from operations, and that is a figure that we can then just simply transfer to the face of our statement of cash flows. Okay. Now, ladies and gentlemen, this is my first little hint when it comes to a question that deals with a statement of cash flows. I normally go through the statement of comprehensive income, the statement of changes in equity, and the notes. In this case, we haven't got any notes, but we do have some additional information in the place of the notes. And what do I do? Um, Perhaps I should just justify what I'm saying first. You know, we've got operating activity section, which consists of two subsections. We've got a financing activity section. We've got investing activity section. We've got the note. They all need some different information for us to extract from what we are being presented with. And normally in a test or exam situation, you haven't got the time to go and read this question through 5 or 6 times. Okay, you really only have one thorough reading through of it. So what I normally suggest is we go through our statement of comprehensive income, we go through our statement of changes in equity, we go through the notes, or in this case, the additional information, and we indicate for us what each kind of activity represents, and then we indicate it for ourselves so that later on, when we deal with the various sections in the statement or in the note, then we can simply come back and look at those items that are applicable. So, ladies and gentlemen, I know this is a statement of comprehensive income. It's not a statement of cash flows, but many of these income items and expense items will have a bearing on your statement of cash flows. Now, I'm going to ask you, please, ladies and gentlemen, I want us to be very interactive today, as interactive as possible. So, obviously, I'm going to ask a few questions. You're welcome to answer them in person, I should say, or you are welcome to type them in the chat. Now, if we look at that very first item, revenue, now, I want us to distinguish between four things, actually, ladies and gentlemen, and this is the point I'm trying to make here. I'm sorry. It sounds a bit strange at the moment, but we are going to indicate if something has to do with our operations. If something has to do with our operations, we are going to indicate it as such. If something has to do with our so-called other operating activities, we're also going to indicate it as such. If something has to do with our investing activities, we are going to indicate it as such. And if something has to do with our financing activities, we're also going to indicate it as such. So that later on, we don't have to read through the whole question again to see where can I find some investing activities or where can I find some financing activities and so forth. Right. So sales, ladies and gents, let me just go back to collaborate. Sales, what would that have to do with? What kind of, which of those four would your sales have to do with? Your sales clearly has to do with your dealings with your customers, right? So what would you say? What kind of activity would that be? Operations, other operating activities? Yes, okay, you get the idea. Thank you, Apiwe. Thank you, Tando. Thank you, Sisipu. Thank you, Supimeze. Right, so it has to do, in actual fact, with our operations. Right, it has to do with our operations. So therefore, ladies and gentlemen, I'm just going to indicate it with a little O there. Just for our own purposes, right? Then the next line item there, interest income. It has a bearing on a cash flow. I know this is an income, but like we said the other day, this also has a bearing on the cash flow, which we call interest received. Now, if you can type for me, is that operations, other operating activities? Milton, looks like you've already indicated it there. Other operating activities. Thank you, Mbusu. Thank you, Langa. So that has to do with our other operating activities. Thank you all. So let me just go back to Word. So I'm going to indicate that as other operating activities. Our next line item there, ladies and gentlemen, profit on sale of investment. Now we know that as it stands there, it's a profit or a loss in if we look at the other side of the coin, but eventually it will have a bearing on our cash flow. So what kind of activity would that represent? Other operating activities, operations, financing, investing. Thank you, Langa. Oh, now there's a lot. There's a lot. Remember, we said the other day, when it has a bearing on your non-current assets, then it is an investing activity. So your investments will be part of your investing activities. So any profit or loss on the disposal of that investment will be an investing activity, as most of you have said there. Okay, so let's indicate that as an investing activity. Profit on sale of property, ladies and gentlemen. Now, this one I think you will all get 100% spot on. What kind of activity does that relate to? Property is part of our PPE, right? And PPE is a non-current asset. Thank you. You've all got that right. So that will also be an investing activity. So let us indicate it as such. Oops. No, let me rather type it again. Cost of sales, ladies and gentlemen, that will have to do with our dealings with our customers, right? And our suppliers for that matter. So what kind of an activity would that represent? Operations. Operations, thank you all, operations. So we are going to indicate that with an O, right? Operations. Then we've got operating costs, ladies and gentlemen. Now, I think the description, the mere description gives it away. Is that going to be part of our operations? Is it going to be another kind of operating activity? Is it going to be a financing activity? Is it going to be an investing activity? What will our operating cost be? It'll be part of our operations. Once again, you'll remember we said the other day, thank you very much, operations. We said the other day, Mrs. Kies will teach you in Financial Accounting 3 that you have to go and reconstruct your creditors account and your inventory account and also your other operating cost accounts in order to determine the cash paid to suppliers and employees. In Financial Accounting 2, we just determine it by means of a balancing figure. So that one also we can now go and indicate as part of our operations. Next one, ladies and gents, finance cost. Finance cost, which is the proper description for interest expense. What kind of activity will that be? It's a tricky one, actually, ladies and gentlemen. I mentioned the other day that there has been a debate for many a year, but I think that's pretty much settled now, that finance cost could potentially be part of your financing activities, right? Uh, Thank you, Mbuso. I think Mbuso is the first one that got that right, and then Mko as well. Okay. So, ladies and gentlemen, what we've said the other day, it has finally been decided that when it comes to your financing activities and investing activities, only the capital amounts will be regarded as cash flows within that section. The income and expenses that relate to your financing activities would rather be disclosed as other operating activities. You remember there we've got a line item called interest. Interest what? If you can type one little word for me there. We've got a line item under our other operating activities called interest that is closely related to finance cost. Paid. There we go. Thank you, Mbuso. Thank you so much. Interest paid. Okay. So that will be part of our other operating activities. So let me just go back to Word. So we're going to say OA, or whichever way you want to indicate it, whatever works for you. Okay, then profit before tax is simply a subtotal, so we're not going to indicate that as anything. Then we've got our income tax expense. Now that is closely related to a cash flow that we called on Wednesday last week, our income tax paid. So what kind of activity would that represent? If you can type that for me. Other operating activities, right? Operating activities, we for our own purposes. Thanks, Scott. Oh, yes, for our own purposes, we just call it other operating activities, but it is part of operating activities, but not part of your operations. So there again, we are going to say part of our other operating activities. Right, and then we've got another subtotal. We have no other comprehensive income. And then we've got a total comprehensive income, which is again just a subtotal. Okay, so we are done with our statement of comprehensive income. We've analyzed that. So let us now proceed to our statement of changes in equity. The first line item is just the opening balance. The last item, the closing balances. And then we've got our movements in between. So our total comprehensive income, again, is simply a subtotal, or in this case, a total for our statement of comprehensive income that we've transferred there. So we've already, in effect, analyzed it. That 199547, we've already analyzed it into its components. Which of the various activities does it represent? So that 199547, we are done with. So now we get to the next one, shares issued. So they've issued shares during the course of the year. What kind of activity would that represent? the issue of shares. Financing. Thank you, Nkobile and Langa. Busa again, thank you all. Right, so that will be a financing activity because it's part of our own capital, right? We said tongue in cheek last week, your financing activities represent your own capital and loan capital, or at least the movements therein. Okay, so we're going to indicate that with an F for financing activities. Our next movement there, our next line item is share issue cost written off, ladies and gentlemen. So we incurred probably some commission that we had to pay to the financing house that managed the share issue on our behalf. So what kind of activity would that represent? Remember, this is still closely. I don't even have to explain. You've got it already. Thank you, Scott. Thank you, Tando. So what kind of activity? It's still part of your financing activities, quite correct. So we are also going to indicate that with an F, part of our financing activities. Our next movement there, our next line item, ordinary dividends declared. Ordinary dividends declared. Now, you remember we said last week that that is closely related to the cash flow that we call, in our statement of cash flow, we call it ordinary dividends paid, right? So it has a close relationship with that. So what kind of an activity would that therefore represent if you think about where in the statement of cash flows? Thank you. Where does that dividends paid, ordinary dividends paid, sit? Under our other operating activities, right? Thank you so much. You are once again 100% spot on. So that will be amongst our other operating activities. Ooh, now it's going to mess a little bit with my formatting. Not yet, but I think the next one will. Then our next movement, our next line item there is preference dividends declared, ladies and gentlemen. Now, that is similar to ordinary dividends declared. It is just a different class of shares. So that will still be part of our line item called dividends paid. Dividends paid, right? So that is part of that. So what kind of activity would that be? Thank you, Apiwe. You've already mentioned this. Thank you, Mabareki. Okay, Scott and everyone else, thank you so much. So that will still be part of our other operating activities. So we are going to indicate that as such. I hope that fits in. Okay, it goes to the next line. Let me just see whether it messed with my, no, it hasn't messed with my formatting. So that is all good then. So that is also another operating activity. Right, ladies and gentlemen. So we are done analyzing our statement of changes in equity. Now, when you have a full set of financial statements, you would have various notes. So you would go through the notes. In this question, we do not have the notes to the financial statements, but we do have some additional information here. So let us now go and analyze our additional information. First paragraph there, they say on the 31st of March 2020, 250,000 preference shares were issued at 55 cents per share, and share issue expenses of 1,150 were paid. We've already seen that here in our statement of changes in equity, the share issue cost write-off. That is, by the way, the description, one of the descriptions that I've just adjusted slightly. Okay, so we've already seen that, but anyway, they provide us with more information there. They tell us how many preference shares were issued. They give us the issue price so we can see what our proceeds on the issue of those preference shares would be. But anyway, to cut a long story short, that's not what we are looking at now. We just want to see what kind of activity that would be, ladies and gents. So if you can type for me or you can say it in person, what kind of activity would the issue of the preference shares constitute? Financing. Thank you so much. Thank you, Nkobile. Thank you, Scott. Thank you, Milton, and everyone else. Right. So that will be a financing activity. So it's part of our so-called own uh, 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 own capital. Right. So we are going to indicate it as such, financing activity, so that we don't have to go and read through all of these pieces of information when we do our financing activity section. Then, ladies and gentlemen, paragraph 2, they say during the year the following transactions took place with regards to the non-current assets. Well, that gives it away already. The fact that they say with regards to non-current assets tells us exactly what kind of activity this is going to be. But anyway, let's read through it in any case. Uh, and were included in the profit before tax. Investments which cost 62,500 were sold at a profit of 6,225 rands. Property was sold for 260,000. No further sales of or purchases of property were made during the year. No equipment was sold during the year. But remember, that does not necessarily mean that no equipment was acquired. They only say no equipment was sold. Okay, so let me just go back to collaborate. You've all written it there already. Oh, wait. There's a little bit of a difference. No, you've all got it right. I just thought I saw one financing, but it's all investing. Right. 100% spot on, ladies and gentlemen. So that will all be part of our investing activity. Normally, I would indicate each item separately with an I, but I don't want to waste our time because all of these would be an I, that would be an I, that would be an I. Then they say there were no components of other comprehensive income. Okay, so if there's no components of other comprehensive income, it would also not involve a flow of cash. Normally, your other comprehensive income does not involve a flow of cash anyway, but in this case, there isn't any, so we don't have to indicate anything there. Then our last little paragraph, paragraph 4, they say an additional short-term loan of 50,000 rands was raised during the year. So what kind of activity would that be? Financing. Yes, financing, spot on. So we can indicate that with an F. Then we've analyzed all our financial statements, the statement, except for the statement of financial position, but we are going to look at that later on when we do our account reconstructions. Okay, ladies and gents, so now we are ready and able to go and start with our statement of cash flows. Now, as we've said last week, it might be a better idea to start with a note because you are going to need the total at the end of the note, which we describe as cash generated from operations, in any case, to complete your statement of cash flows. Right, so we are going to start with that. What is the first line item under the title, ladies and gentlemen? If you can type that for me, please, under the title of that note where we say a reconciliation of something with something, which is our first line item? Where do we start that note? With which line item? Profit before tax. Thank you, Langa. Right, we start with profit before tax. So that is something that we can find. In which statement, ladies and gentlemen? In which statement can we find profit before tax? It's a disclosable item, so it'll appear on the face of that statement. Income statement or statement of comprehensive income. Quite correct. Right, so let us go and search for that. So we go to our statement of comprehensive income. There we go. And we see there is a figure called profit before tax, or a description called profit before tax. And there we've got the figure. So we simply take that figure and that we are going to insert. We're going to paste it. I've already done this because you have the answer in the question bank. So I'm not going to type it in. It's already typed in. So we simply take our profit before tax figure and we transfer it to our notes. So I've got that here on my 4th page. And oops, that's the 5th page, I think. There we go. So there we've got the heading, reconciliation of profit before tax with cash generated from operations. There's our first line item, profit before tax, just like we've seen on the face of our statement of comprehensive income. And that is the same amount. That is where we start. Right. Then we said we've got to make two kinds of adjustments, ladies and gentlemen. We've got to make two kinds of adjustments. We've got to go and adjust, first of all, for any kind of income or expense that does not relate to operations. In other words, we've got to adjust for income and expense items that relate either to other operating activities or to investing activities or to financing activities. Right, that's what we've got to go and adjust for. So let us go and see what we have again. So let's maybe start with our where did we start? We started with our statement of comprehensive income. So we are now looking for something that does not have to do with operations. We can see there that our sales, ladies and gentlemen, our sales was part of our operations, but then we have the interest income. The interest income. Now, the interest income, the way that we've got to think this through, ladies and gentlemen, it has already, as you can see here, it has been taken into account in arriving at your profit before tax. So it's already in there, but it's not part of your operations. So therefore, we've got to go and adjust for it. So our interest income, we'll have to go and use, let me just highlight that figure before I go down. Where is it? Interest income, 1,600 rands, right? So we're simply going to take that figure. We go down to our note. Oops, again, I've gone too far. I'm sorry about that. And there we see, right? Interest income. We are going to adjust for interest income. Now, the question here is, should we show that as a positive or should we show that as a negative? Now, that sometimes initially, when you start with a statement of cash flows or the note, it might take a little time for all this to sink in because it is a lot of information. We recognize that. But the way that we've got to think this through, ladies and gentlemen, you can just type for me yes or no. I know we've already said this, we've already answered the question, but I just want to test whether we are all on the same page. So in calculating profit before tax, has the interest income been added or has it been deducted to get to profit before tax? Thank you, Mr. Genie. Thank you, everyone. It has been added because it was income in our statement of comprehensive income. It was added in order to arrive at the profit before tax figure. But now, ladies and gentlemen, we want to take it out. It has been added already, but we want to eliminate it. We want to take it out of that figure. So what do we have to go and do with that amount of 1,600 rands now? Do we now add it a second time or do we deduct it? Thank you, Sisipo. Thank you, Milton. Thank you, everybody. There's a lot of answers. Thank you so much. Now we've got to go and deduct it to eliminate it. Remember, our point is we want to arrive at a figure that only deals with operations. Even though it's still a profit or a loss, it will only deal with operations. Okay, ladies and gents. Now let's go back again to our statement of comprehensive income. We'll see if there's anything else that we need to go and eliminate. There we are. Again, I think my system is a little bit slow. I scrolled down too far. So that one was not part of operations. Then we've got this one here. Profit on sale of investment. We've indicated with it with an I. So clearly that is also not part of our operations, ladies and gentlemen. So that means we have to go and adjust for it. So we've got the income, which is profit on sale of investment, 6,225 rands. We simply copy that figure over. We take it to our note. So let us go there. Oops, again, too far. So there we've got it. Profit on sale of investment, exactly the same description, exactly the same amount, 6,225 rands. So now our only question remains whether we should show it as a positive or a negative. And you'll see we are developing a pattern here. We'll talk about that pattern very soon. We are developing a sort of a pattern. The way we have to think about this, ladies and gentlemen, we can clearly see it. We can clearly see it in our statement of comprehensive income. If we just go back there, we can see that the profit on sale of investment has been included. It has been added there in arriving at your profit before tax figure, right? So in arriving, in calculating your profit before tax, it has already been included. Have we originally added it, or have we originally deducted the profit on sale of investment when we calculated our profit before tax? We added it. Thank you so much. We added it. So now if we want to take it out, if we want to go and eliminate it, do we have to add it again, or do we now have to subtract it or deduct it? Deduct it. Thank you all. Exactly. You get the idea. In order to get rid of it, to eliminate it from the profit before tax because it's not part of operations, we now have to go and deduct it because it has already been added previously. Okay, so now let us go back to our statement of comprehensive income. Let's see if there's anything else. If we scroll back up, there we go. Our next item, there we've also indicated it with an I. We've indicated it with an I. And what is that? That is the profit on sale of property. So that clearly means we've already analyzed it. We've seen it relates to our investing activities. It does not relate to our operations. So therefore, we need to go and adjust for it. So we're going to use that same description. We're going to copy it over, profit on sale of property. We're going to use that exact same amount. We're going to copy it over. And you can already see here that has been added to our sales and to our revenue to arrive at our profit before tax. So we had our sales, we had our revenue, or our two kinds of revenue from sales and revenue from interest income. We've added the profit on sale of investment. We've added the profit on sale of property to arrive at our profit before tax. So we don't need to come back to here. We already know now. To eliminate it, we'll have to go and deduct it. But we'll go through the argument again. So, oops, too far again. Okay, so there it is, profit on sale of property, right? So we can just copy our description and we can copy our figure. And then we must determine whether that should be shown as a positive or a negative. So what are we saying? We are saying that when we calculated profit before tax, we added that. We already added that to our revenue and any other form of other income, right? In arriving at profit before tax. But now, in this note, in this reconciling note, we want to take it out. We want to get rid of it. We want to eliminate that figure. So that means now, ladies and gentlemen, we have to go and deduct it. We have to go and deduct it. Now is perhaps a good time to talk about the pattern that we are sort of creating here, or the trend that we can find here. You can now clearly see if it is an income in our statement of comprehensive income that we are eliminating, it means we have to go and deduct it in the note. The opposite will also be true if it is an expense in our statement of comprehensive income that we want to go and eliminate. We will have to add it back, but we'll see that soon. We'll see that soon. Let us go back to our statement of comprehensive income. Let's see if there's anything else that needs to be eliminated. So where were we? We were there with a profit on sale of property. Cost of sales is part of operations, so we simply leave it in our profit before tax. Operating cost is part of operations, so we simply leave it in the in our profit before tax. Right, so the next one here, finance cost. There we've indicated it was OA. So there we've indicated as an other operating activity, not part of operations. So that means we have to go and adjust for it. So we can simply take this description that we have in our statement of comprehensive income, we can copy it and we can go and paste it in our note. We can take the figure there, we can copy the figure and we can go and paste it in our note, right? So let us go to the note, ladies and gentlemen, but let me just go back to the statement of comprehensive income. Here we can see the finance cost was deducted, right? In our statement of comprehensive income, the finance cost was not added to arrive at profit before tax, it was deducted. So let us go down to our note. There we are. Right, there we've got that description, exactly the same description. We've pasted it there, finance cost. We've also pasted the figure there, 68,134 rands. Okay, but however, ladies and gents, we must still go and determine whether that should be shown as a positive or a negative. So let us go through the argument again, the justification. In arriving at our profit before tax, now, this is the first of this kind that we are having, so maybe it's a good idea for you to type it. When we calculated our profit before tax in our statement of comprehensive income, did we originally deduct the finance cost or did we add it? We deducted it. Thank you, Nkobile. Thank you, Supumeze. Thank you, everyone else. Right, we originally deducted it, but now we want to nullify its effect. We want to eliminate it. So what do we have to go and do now to nullify it? Plus or add back, add it, add. Thank you so much. Now we've got to go and add it back to nullify its effect. Right, ladies and gentlemen. Okay, so far so good. Perhaps this is a good time just to pause for a few seconds. Are there any questions so far? We've also got the income tax expense. Now, last week we discussed this, ladies and gentlemen, the income tax expense. So clearly that is also not part of operations. Now, last week it was a trick question. Today is again a trick question. So do we need to go and adjust for the income tax expense? Just a yes or no? You say no. Thank you, Mareki. Thank you, Longa. Thank you. No, 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 no. Lots of no's. Why not, ladies and gentlemen? Because the income tax expense, as you can see, maybe I can just indicate it there. The income tax expense there is below the profit before tax. We did not start our reconciliation with profit for the period. If we had started with a profit for the period, yes, then we would have had to go and add the income tax expense back. That is true. But we have started our note with that figure, the profit before tax. So the income tax expense has not been deducted yet, and therefore there is nothing to eliminate with regards to the income tax expense, right? So that is the reason why we do not go and adjust for that. It has not been included in profit before tax yet. Okay. So now we are done with our statement of comprehensive income. Fortunate for us, we've already analyzed all our statements between the various kinds of activities. So now we can simply go and search for some more activities. Right, ladies and gentlemen, here we've got our statement of changes in equity. First of all, we've got our shares issued. Now, that is not an expense. In fact, ladies and gentlemen, it is very rare that you will find an expense in this statement. The only one I can immediately think of really is only our share issue cost right off. But that we've said we are going to see as part of our financing activities. We are actually just going to show the net amount. So maybe we can just make a little a note of that there. Then, ladies and gentlemen, so that's part of our financing activities, but shares issued is capital. It's capital. It's not an expense. It's not income. It's neither income nor an expense, right? It is equity that has been issued. And that is part of the cost of issuing the equity. And IAS 32, which deals with share capital, you remember from our second term, we said we must always just show the net amount. In other words, your share issue cost will be written off against that class of shares capital. Then we've got ordinary dividends declared and preference dividends declared, and we see both of them are not part of operations; they are part of operating other operating activities, right? So our question here, I know this is again a little bit of a trick question. Should we go and adjust for that? Should we go and adjust for that? Yes or no? Thank you, Mr. Genie. Thank you, Kubile. Thank you, Scott. No. And again, the reason is the same. Scott, I'm going to take your hand in a second. Let me just finish this little sentence, and I'm going to take your hand. Um, the reason is the same as with the income tax expense. Remember this, your ordinary dividends declared it does come after your profit before tax, right? It comes after. Remember, you transfer your total comprehensive income to your statement of changes in equity, and then your dividends get declared thereafter. So the dividends declared is not included in your profit before tax. That is the main point here. It's not included there. So if it's not included in there, then you cannot go and adjust for it because there is nothing to adjust. It has not been deducted yet. If it had been deducted, then we would have added it back. But you can clearly see that happens afterwards. So it has not been deducted yet. Scott, I think you had a hand up. Yes. Scott, you must just please unmute your mic.
I'm sorry, I was putting my
No
earphones.
problem.
Okay,
No problem.
I wanted to know if you have done the depreciation yet, because I noticed that in the cash flow statement you already calculated the depreciation. Since I'm late, I was wondering if you have done it yet.
Oh, we haven't yet. We haven't yet. No worries, Scott. We haven't yet. We haven't got to that yet. We've only looked at the items on the face of our statement of comprehensive income at this stage. Your depreciation you will normally only find in your notes, so you'll find that in your profit before tax note. So we must still go and have a look at the notes. So we haven't done that yet.
Oh,
We're
okay, okay, thanks.
still getting there. Okay, perfect. Thank you for that question. That might help a few other people who also might have been a little bit late. Okay, so now we've analyzed or we've looked at the items in our statement of comprehensive income. We've looked at the items in our statement of changes in equity, but now we must still go and have a look at the items in our notes. Now, as we said earlier today, we haven't actually got the notes to the financial statements, but they've provided us with some figures and some facts here that basically come from the notes. Okay, so ladies and gents, let's go and have a look at our notes here. Right, so we see here on the 31st of May, or that whole sentence, that has to do with financing activities. But as we can see there, the only expense that is included there is again the share issue expenses, and in accordance with IAS 32, that should not be written off as an expense. It should be used to reduce the capital amount. That is why it is not seen as an expense that we have to go and adjust for, because it is not shown as an expense in our statement of comprehensive income. It is an amount, it is a cost, it is an expense, but we use it to reduce the capital value of the share, issued share capital. Right. Then we've got some notes here that deal with our investing activities. So there they see we see that we've purchased some investments, property was disposed of, no equipment was sold during the course of the year. Okay, ladies and gentlemen, so now we'll have to go and start reconstructing our various ledger accounts, right? So let us maybe start with the investments, because as Scott has pointed out, we haven't got the depreciation figures yet. So that is something that we must still go and determine. Let us just see. Let us just have a look at our statement of comprehensive income. No, we don't see the depreciation anywhere there. It's probably been allocated to as part of our operating costs. So it's in there somewhere. So if we had a note, a profit before tax note, then the depreciation would have been indicated in there. But we haven't got that note. They also don't provide it to us here. Let us just see what else we have. We haven't got anything else that indicates that. So the only way that we can go and do that, ladies and gentlemen, how we can determine the depreciation or impairment losses for that matter, or amortization, which someone mentioned last week, would be to go and reconstruct those ledger accounts. So, ladies and gentlemen, normally I would now start with the rest of the statement. You know, the movements in your working capital or changes in working capital. But in this case, in this particular question, they haven't provided us with the depreciation amounts, right? If they had, then we could simply take them from our notes to the financial statements and complete that adjustment sections and carry on. But in this question, they haven't. So that makes it a little bit trickier, which means that we will need to go and reconstruct our various non-current asset accounts. So we'll have to go and scroll up all the way up to our non-current assets. We'll have to see what kinds of non-current assets do we have. So we have property. There's our property. We have equipment, and we have vehicles, and we have investments. That should actually be disclosed as financial assets if this had been a statement of financial position that is ready for publication. And then we also would not have indicated property and equipment and vehicles separately. We would just have had one line item called property, plant, and equipment. So clearly this statement of financial position is not quite ready for publication yet. It still has to be tweaked. But all this information is simply given so that we can go and calculate that. Okay, ladies and gentlemen, before we even go and reconstruct it, maybe we can just have a look at what we see here. We see that in the case of property, there's no cost and no accumulated depreciation given, right? It's only property. Perhaps we can change that property. Well, it could be at cost or it could be at valuation, depending whether they are using the revaluation method or the cost model. So clearly they are not writing off depreciation on their property. So that one we can simply disregard, right? Then we go and have a look at our equipment. We are going to have to reconstruct these accounts a little bit later on, but let us just see what information we have. At least in this account, in this question, in this question, they give us the cost and the accumulated depreciation separately. If they hadn't, if it was only the carrying amount, then we would have had to go and reconstruct these accounts now. But we'll have to go and reconstruct them at a future point in any case. But at least now we don't have to do it yet. Here we've got the accumulated depreciation on equipment and the accumulated depreciation on vehicles given to us as separate items. So we can simply use the increase or decrease to calculate what the depreciation for the year was. Okay, so let us look firstly at equipment. So we've got equipment cost and then equipment accumulated depreciation. So the accumulated depreciation at the beginning of the year on our equipment was 60,000 rands, and at the end of the year, the accumulated depreciation is 84,000 rands. Right. So how much is the depreciation expense on equipment for this financial year? If you can type that for me, please. 24,000. Thank you. So it means our depreciation expense on equipment for this year, thank you all for that, for those answers, would be 24,000 rands. Right. So we can do the reconstruction later. Same with our vehicles, ladies and gentlemen. We've got vehicles at cost and we've got the vehicles accumulated depreciation. The opening balance at the beginning of the year was 0. The closing balance at the end of the year is 30,000 rands. So that means how much was our depreciation expense for the year on our vehicles? 30,000 rands. There we get it, Scott. I see you have answered this. So now you see we're only getting to it now. Okay. So clearly, ladies and gentlemen, our depreciation expense for the year on vehicles was 30,000. So in total, our depreciation expense would therefore be 20 plus 30, 54,000. Right. So let us go and see in our note. Thank you for those answers. So we go down to our note. Not go too far. That is still the main statement. There we go. So there we've got our depreciation. So our adjustment for depreciation. Now we can just combine the two. It was 24,000 rands depreciation on equipment plus 30,000 rand depreciation on vehicles. So our total depreciation for the year, as you've typed in the chat there, is 54,000. Right. So I can see you all know where that comes from. Right. 54,000. But ladies and gentlemen, we must still ask ourselves that further question: should that be shown as a positive or should it be shown as a negative? Now, we speculated a little bit earlier, you know, from the first semester, how we draw up a statement of comprehensive income. So we speculated earlier that your depreciation would probably have been allocated to your operating cost. There could be other kinds of cost functions, as you know, administrative cost and distribution cost. They've only got 3 kinds of cost here, those 3, right? So it would probably have been allocated to your operating costs. So your depreciation would be somewhere within that figure of 169975. And you can see on the face of our statement of comprehensive income, the operating cost was deducted from our revenue and from our other income to arrive at our profit before tax. So if we go to our note now, there we've done the adjustments. Our question, let's just go through the logic again, ladies and gents. I know that many of you have already answered the question there. In arriving at the profit before tax figure, in calculating the profit before tax figure, would we have added the depreciation to our income and our revenue, or would we have deducted it? We would have deducted it. Thank you, Apiwe. Thank you, Scott. Thank you, everyone else. We would have deducted it. But now, because it is an investing activity, thank you all for those answers. Because it's an investing activity and not part of your operations, we have to go and take it out. So if we have already deducted it, we cannot deduct it now for a second time, ladies and gentlemen. We now have to go and, if you can type for me, add it back. Yes, we've got to add it. We've got to add it back to eliminate it, to get rid of it. We want to take it out of our profit before tax figure because we want to arrive at purely a profit or loss that relates to our operation. So now we've got to add it back. Thank you so much. You've all got that correct. Spot on. Right, ladies and gentlemen, so now we've really adjusted. There's only a few other things that could have been possible if there had been accumulated impairment losses on that face of the statement of financial position. Clearly, the impairment loss would then have to be will have to be added back. If in our financial assets we have accumulated amortization, that means we would have written off amortization expense this year, which we are not doing in financial accounting 2 anyhow. You'll do that next year. In financial accounting 3, when you do intangible assets, you'll encounter amortization, similar principle to depreciation. Then you would have had to go and add it back. But in this question, we haven't got any of those. Okay, before we go to the next kind of adjustment, ladies and gentlemen, let's just pause there for a few seconds. Have you got any questions that you'd like to ask? No questions. Okay, then so far so good. Then we can carry on. Right, so our first major kind of adjustment would have been to, oops, there's a subtotal missing there. I'm sorry, I'm going to type it in just now. So our first major kind of adjustment was to take out any income or any expense that does not relate to our operations. But now we're still sitting with either a profit or a loss. It's not been converted to a cash flow yet. So here we are going to provide a little subtotal, ladies and gents. My apologies. I don't know why that got left out. Let me just type that in. So we're going to call that operating profit before, what did we call it here? Well, let's just call it working capital changes. Operating profit before working capital changes. And now we'll just have to go and calculate that quickly, ladies and gents. Okay, it looks like it wants to go to the next line. So let me go to the next line then. I'm sorry, it will just have to be there. I can't get it to go anywhere else. Let us just check the calculations, ladies and gents. So I'm grabbing my little calculator here. Let's just double check our calculations. 54,000 minus 35,000. You can do this with me. You can audit me, please. Minus 6225 plus 68134, 68134. I'll look at those entries just now. Minus 1,600. That gives me not 12,775. I get 79309. What do you get? 79309, 79301. Welcome in my world, Mrs. I somehow suspected when I looked at those figures that the 12,000 doesn't look right to me. Okay, so you all say that's 79309. That's what I get as well. So let's just go and change that. Sorry about that. I must say that looked not right to me. Ugh, no, I didn't put on my numlock. Where am I now? 79 309. Okay, 79309. Positive or negative, ladies and gents? On my side, it looks to be positive. Positive. Okay, thank you all. Thanks, Mrs. Skis. I don't know how that little error slipped in, but like I say, for some reason it just didn't look right to me. Okay, so it's 79309 plus 288491, and that then gives us, if my calculation is correct, 367,800. That's what I get. Let me just see, students, what you've got. You've got that as well, 367,800 positive. Okay, 367,800 positive. So we seem to be in agreement there. Sorry that it's not now in exactly the same line, but it doesn't seem to want to go up. Let's see if I think it's going to scroll down. Ah, that's not going to help. Okay, but anyway, so that one relates to that one. Okay. Let's just complete the calculations, ladies and gentlemen. 367,800, 367,800. While we've got this in our computer memory, minus 24720, 24720 gives us 343,080. Okay, so that seems to be right then. Phew! It is always, as Mrs. Keys also indicated, it also always comes as a bit of a surprise when you're working through a question and the answers aren't correct there. Okay, but we've corrected it now, so all's well that ends well, as they say. So now, ladies and gentlemen, we've got to do our second major kind of adjustment, and that is to convert that profit, that operating profit, into a cash flow, the cash flow that we call cash generated from operations. So to do that, it means we have to go and nullify or cancel the effect of the accrual system in those items that we consider to be working capital. And we've explained last week, I think you still took a note, what is meant by working capital. So it's those current assets and current liabilities that are directly related to your operations. So we're going to start with our inventories. Now we know we can find that on the face of our statement of financial position. So we're going to scroll all the way up to that statement. There we've got inventories. Now you can do the math for me. It looks like the rest of the figures seem okay. We started the year with inventory of 65,600. We ended the year with 73,000. So therefore, is that an increase or a decrease in inventory? And also how much, if you can say increase or decrease, and how much, please? You just scroll down and then I'm going to have a look at your answers. 7,400 increase. Thank you, Inga. Thank you, Nkubile. Thank you, Mayiwa. Okay, so we're all in agreement. It's an increase in inventory of 7,400. Thank you all. Thank you for those answers. Right, ladies and gentlemen, but now we've said to get the figure is not the only part. We've also got to say whether we should now show it in brackets or not. There are various ways in which you can explain it. The way that we did it last week was the philosophical way. We said, is more of your money tied up in inventory than last year, or is less of your money tied up in inventory? You can just say more of our money, more or less. More of our money tied up in inventory this year as compared to last year, or is less of our money tied up in inventory? If there's an increase in inventory, we've got more. Thank you. More of our money is sitting in the warehouse. You remember we said tongue in cheek, your money is not in your bank account. That additional money, it's sitting in your warehouse. You've got more. You've got additional inventory as compared to last year. So that will be similar. It is not an inflow or outflow, but it will have a similar effect to an outflow of cash. So therefore, we are going to show it as a negative. Now we have to go and look at our trade and other receivables, ladies and gents. We also know that we can find that on the face of our statement of financial position. So we have to go all the back to the statement of financial position. There we've got accounts receivable. So that will be included obviously in our trade and other receivables. So here we can go and have a look. We started the year with 76,580. We ended the year with a total balance of 70,825. So if you can type for me, please, ladies and gentlemen, whether that's an increase or a decrease, and also by how much. Right, decrease by 5755. Thank you. So then this time the answer is correct because I believe you. Thank you. So it is a decrease in your trade and other receivables of 5,755 rands. Right. Now, again, there are a few ways in which you can look at this, whether it should be shown as a positive or a negative. I like the philosophical way. You can also calculate it by means of reconstructing your ledger accounts. So let's maybe just discuss two philosophies there, ladies and gentlemen. Is more of your debt, more of your money this year compared to last year, this year compared to last year, is more or less of your money tied up in your debtors balance? Less, right? Less money is tied up in the debtors balance, which means that more money should therefore be available in your bank account, theoretically, as compared to last year. Or if you want to look at it differently, you can ask yourselves if the debtors balance is lower this year than last year, have our debtors paid us better this year or worse this year than last year if their outstanding balance is less? They have paid us for better or for worse? They have paid us better, right? Because there's less outstanding, right? Smaller amount outstanding, so they have paid us better. Thank you, ladies and gentlemen. So like we said last week, that will therefore be similar. Even though these are not in and outflows, they are the elimination of the accrual system. It has a similar effect to an inflow of cash. More money in the bank, less money tied up in our debtors, right? So we are going to show that as a positive. Just before we look at the next one, ladies and gentlemen, let us, and the next one is our trade and other payables. I just want to ask you a little bit of a trick question again. We see that there's also another current asset there. When we were there, we saw there's another current asset. There's a current asset called current tax refundable income tax. Current tax refundable income tax. My question here, and this one you'll have to think about a little bit, so I'll give you a few seconds there. Should we go and look at the change in that figure, in that reconciling note as well? Yes or no? No, you're quite right, Ms. Chitini, Kubile, Tabisa, you're all right. Thank you, Sayanda, Asemasle, Bongi, Simamkeli, you're all correct. No, and why not, ladies and gentlemen? Because our current tax refundable income tax has got a close relationship with something that we refer to as our income tax paid, right? It is all part of that whole account, right, of that whole scenario. So it is not part of operations. So because your income tax, whether you owe it or whether they owe it to you or whether it's an expense, because it's not part of operations, we do not include it there. In other words, that is not part of what we refer to as working capital, right? So your capital, your current tax refundable is not part of working capital, right? And then bank, we said that is our target. So one of our targets. So we're not going to show that in any case. So now we can go to our current liabilities. So we see there's quite a number there. There's accounts payable. So that's the one that we'll have to go and have a look at. But before we do that, ladies and gentlemen, let's talk about these. Current tax payable, income tax. Should we include that? The current tax payable income tax. Yes or no? No, thank you. Thank you, Langa. Thank you all. Thank you all. No, and the reason again being it is not part of the working cap. So it's not part of your day-to-day trading activities, your normal trading activities. So you're not going to include that. What about the short-term loan, ladies and gentlemen? The short-term loan that we have raised, that is under our current liabilities. So should we use that in our reconciling note? Also, no. Also, no. Why not? Because it relates to what kind of activity? Let's take this argument to its ultimate point. That relates to what kind of activity? Financing. Thank you, Kubile. Again, thank you. That relates to financing. So it's not part of operations. So therefore, thank you, Apiwe and everyone else. So that is not part of operations. So it's therefore also not considered to be part of our working capital either. And then we've got shareholders. We owe obviously money to our shareholders. There's a little note at the bottom there with the asterisk where it says this relates to ordinary and preference preference dividends that we still owe to our ordinary and preference shareholders. What kind of activity would that represent? This is a tricky one because that relates to our the cash flow that we call dividends paid, right? And the dividends paid, we said, falls under our other operating activities. Thank you, Langa. Under our other operating activities. So again, thank you, Scott. So again, and Apiwe as well. So again, it cannot form part of operations, and therefore it's not part of your working capital either. So the only one that we have got to take into consideration here, the only one that deals with our own wheelings and dealings with our suppliers and employees. Remember, that is the key here. Your operations has to do with your wheelings and dealings with your customers on the one hand and with your suppliers and employees on the other hand. That's why we used inventory, which is part of our dealings with our customers as well as our suppliers and employees, or at least our suppliers. And then the accounts receivable, which represents our credit customers, and then the accounts payable, which represents our credit suppliers. Right. Okay, long story short, mouthful, thank you. So now we go and have a look. Did it increase or decrease at the beginning of the year? We had a balance for accounts payable outstanding at 71,250. At the end of the year, that outstanding balance is 48,175. So I'd like you to type two things for me, ladies and gentlemen. Does that represent an increase or a decrease from the beginning of the year to the end of the year? And also by how much? Decrease, 23,075. Thank you so much. There we've got a lot of answers. Decrease by 23,075. Let me just go scroll down as well. And there we've got a decrease. So we can't remember, we said last week, you can't just describe it as trade and other payables because this is not your statement of financial position. You must say what happened to it. So decrease in trade and other payables. You've already given me the amount, 23,075. You've already said that it is a decrease, ladies and gentlemen, but this is not an asset. This is a liability. So now we've got to go and decide, should we show this as a positive or negative? Again, there are many ways in which you can go and figure that out. I like the philosophical way. So you can ask yourselves, did we pay our creditors, our suppliers, did we pay them better this year as compared to last year, or did we pay them worse? Quite correct, Nkubile. You've got the idea there. Scott, also you. We are paying them better, so it means more money. As relatively, thank you all of you, Mosupa as well, Miwiwa. So thank you very much, ladies and gentlemen. So we have paid them better because we owe them less at the end of the year, which means more money flowed out of our bank account as compared to last year, right? So therefore, it is similar to an outflow. We can also ask the question, did we make better or worse use of the credit facilities that they've provided us? We've made worse use of the credit facilities because we paid them better, right? Those two go hand in hand. We paid them better, which means that more money flowed out of our bank account to our suppliers this year as compared to last year, right? So therefore, it's going to be similar to an outflow, right? Similar to an outflow of cash, so we're going to show negative. Okay, ladies and gents, so we are basically done. We can now just go and add it up. So we take our subtotal there, 367,800 minus the 24720. And that I think we've already checked. Maybe you can just double check. That should give us 343,080. I think we have actually checked that. Yeah, we did check that a little bit earlier. Okay, so we are done with the notes. So now we can start with our main body of this statement. Ladies and gents, once again, this is maybe a good time to pause a little. Are there any questions from your side at this stage about the note? So this is the cash generated from operations calculated or disclosed by using the indirect method. All happy so far? Okay, ladies and gents. So all that is left for us to do is to go and copy this figure and this description. Remember, we've got this description, cash generated from operations. And remember, again, I've just got to remind you another time that this is not cash generated from operating activities, because there are still 5 other possible operating activities, right? This purely relates to our dealings and wheelings with our customers and our suppliers and employees. So that is our operations, our day-to-day normal trading activities, right? So the cash generated from operations and the figure 343080, we can now copy. We take it over to the main body of our statement of cash flows. There it is, right? There it is, same description, cash generated from operations, amount 343080. Now, ladies and gentlemen, we can either go and calculate our cash received from customers, or we can go and calculate our cash paid from suppliers and employees. The easier one of the two is the former. So it's much easier to go and calculate that than to calculate that. So in financial accounting 2, we are going to calculate that, the cash receipts from customers, and that one, cash paid to suppliers and employees, will then simply be the difference between that figure and that figure that we've already calculated. Mrs. Kies and her fellow colleagues in Financial Accounting 3 will do reconstructions of various accounts next year in Financial Accounting 3 with you, which also gives you an alternative way in how to calculate cash paid to suppliers and employees. Right, ladies and gentlemen, so now we need that figure. We need the cash flow, the cash, the amount of money that we have received from our various customers, either from our debtors paying their accounts or from cash sales. So we need the money that we've received from the customers. Now, we said last week, we have designed a technique for ourselves in how to do that, because we said that normally on the so-called balance sheet or statement of financial position account, where the accrual takes place, the recording of the money received also takes place, right? So we get both of that. So it's almost like a magic account. So which account will the accrual for cash sales take place on, as well as the recording of the cash that we've received from our customers? What is that account? We know that we can call it whatever we want in our ledgers, but we normally disclose it as trade receivables. We're just going to call it debtors, right? We call our ledger account debtors, but we know when we draw up our financial statements, that's going to be trade receivables. And if we've got other receivables, we're going to call our description trade and other receivables, right? So the magic account that we're looking for is our debtors account. Why? We've mentioned that last week already. I've mentioned it again, but I'm just going to reiterate it. That is because the accrual of our credit sales was recorded there. When we made our credit sales, we would have recorded it on our debtors account. And when our debtors made payment to us, we would also have recorded it on our debtors account, right? Besides the bank account, also on the debtors account. So if we now can go and reconstruct that account, in other words, draw it up in summary, how it would have looked last year, or this year, I should say, during the course of this year, then we can find the cash flow. So, ladies and gentlemen, the opening and closing balances, can we find that in any of the other financial statements? Just a yes or a no first, please. Can we find the opening and closing balances for our debtors? In our other fund, yes. Yes, thank you, Mr. Genie. Thank you, Asimasle. Yes, in which statement? Thank you, Nkobile. Thank you, Bonga. In which statement? Where can we find that? Financial position. Thank you, Apiwe. Statement of financial position. So we can find that, ladies and gentlemen. Statement of financial position. Thank you, Asimasle. Thank you, Simamkele. We can find that. The other side of the coin, besides the cash flow, the sales, can we find that in our financial statement somewhere? Yes or no? Initially, the sales that we've accrued, can we find that in some of our other financial statements? Yes or no? Answer is yes. Thank you so much, all of you. Right. In which statement? That's the subsequent question. In which statement? Where can we find it? Either on the face of the statement or in a revenue note. But the revenue note belongs to that statement. Income statement or comprehensive income. Yes, our statement of comprehensive income. Thank you for all of those answers. So now let's go and reconstruct our debtors account. So we're going to draw a little T account for ourselves. Normally when I do this on a whiteboard, I will just draw very awkward and my lines are never very straight. I start too high and then end too low, or vice versa. But anyway, I'll just draw a big T account on the board and then we fill in the figures. So let's start with our statement of financial position. We go and look at our debtors. There we have it, accounts receivable, ladies and gentlemen. So we look at the beginning of the year balance, 76,580. And we look at the end of the year balance, 70,625. Now, the first thing that we have to understand when we take these opening balances is whether it is a debit balance or a credit balance. So at the beginning of the year, I'm not talking at the end of the year, or at the end of the year, doesn't matter. At the beginning of a year, at the beginning of any financial year, this being a current asset, your accounts receivable being a current asset, will that opening balance be a debit or a credit? A debit. Thank you all. Thank you, Gubile. Thank you, Merville. Thank you, Sayanda. Okay, thank you, Luto, Simankele, all of you. Thank you so much. Right, it will be a debit balance, ladies and gentlemen. So we have to go and take that down, or wherever we are doing our T accounts, where we drop our T accounts. We've done it already. So we are going to put that on the debit side of our debtors account. Oops, I scrolled too far again. Let's see where we are. There we've got our debtors. Here you can use abbreviations. Remember, this is only for your own work. This is only for your own calculations. Right, so our opening balance would be 76,580 rands at the beginning of the current financial year. That comes from our comparative column, so that will be at the beginning of the current financial year. Now, ladies and gentlemen, when we get to next year, will our opening balance for next year be a debit or a credit? This still being an asset. Remember, it's still a current asset. So our opening balance for next year, will that be a debit or a credit? Sorry, Apiwe, I've got no control. Thank you, Nkobile. Thank you, Sayanda. Thank you, all of you. Right. So it's still going to be a debit for next year at the beginning of next year. So we take the figure in our current year column and we transfer it over to the debit side. Oh, sorry, where are we? Sorry, I think I moved away from debtors. What happened to my debtors? Oh, there it is. Sorry, just below. So there we go. There, normally I do the debtors right on top. That's why I was looking for it right on top. Okay, so it's still an asset, so it's still a debit balance at the beginning of the year. Now, ladies and gentlemen, I'm going to say something, and I'm going to say it probably 100 times over the next week or so. Where does that come from? The reason why I'm saying it so many times, I want you to hear it in your heads. I want you to hear my voice in your heads when you're doing these reconstructions. Where does that 70,825 come from? It comes from the opposite side above the line, right? I want you to remember this little phrase. It's still an asset, so it's still got an opening balance that's a debit in the new year. But where does that opening balance in the new year come from? It comes from the opposite side above the line. What line am I talking about there where your total is, right? It comes from there. When you would have made your when you would have done this ledger account in chronological order, you would have calculated your balancing figure there, and you would have carried that balance forward. But because we are reconstructing it, we are doing that same thing, but only in reverse, right? So we're in reverse gear here. Brum, brum. We're in reverse gear. We're going back. So we know that it's a debit. Where does that debit balance in the next financial year come from? It comes from the opposite side above the line, right? So now we've already got two figures in the reconstruction. We've got our opening balance for this year, and we've got our opening balance for the next year, which is also our closing balance for this year. Now the other quantity that we need, that we can find on our statements, in our financial statements, as you've already said, is our sales. So let us go and have a look at our statement of comprehensive income. There we go. They haven't got a revenue note. They've got both kinds of revenue disclosed on the face of the statement. We're not interested in interest income because that is not part of operations. We're only interested in sales, right? The O there. So our sales for the year amounted to 1,750,000 rands, ladies and gents. We transfer that over to our reconstruction of that debtors account. So we go back to our little T account there. Oops, too far. Debtors now. Okay, ladies and gentlemen, when we would have recorded our sales, would we have debited or credited sales? when we accrued them, when we made our credit sales and we accrued them, sales being an income, would we debit or credit sales? We would have credited sales. Thank you so much there, Magabongo and Merville and everyone else. We would have credited sales, which means we would have accrued the amount owing to us by our customers. In other words, our debtors, right? So we would have accrued it there. So we would have credited sales, we would have debited debtors. Right, ladies and gentlemen, now we're in that fortunate situation that we've only got one outstanding figure, one unknown quantity, and we can already conceptualize what could possibly that be. What could that possibly represent? It can only represent the amount that was remitted to us by our customers, right? The amounts, in other words, that we've received in money from our debtors and our cash sales, right? So every time that a debtor pays us, every time that a debtor pays us, and remember this is in summary, every single time that the debtor makes an EFT into our bank account, we're going to debit the bank account and we're going to credit debtors on the first day of the month, on the second day of the month, every time. In total, ladies and gentlemen, all of those will be similar transactions. Every time that they pay us money, we're going to debit the bank account, we're going to credit the debtors account. So here we can go and already type in, we can go and conceptualize what is our contra account going to be. It's going to be our contra account's going to be bank, right? That's why it's been bolded. And you remember we said last week, every time that bank is your contra account, it means it represents the flow of cash. Right. So we've got that, ladies and gentlemen. So we can now simply go and add up. Our debit side should, if there's no mistake, our debit side should add up to 1,826,580 rands. Should add up to that. We copy that total over to the opposite side there, and then we deduct that figure that we already have, and then our balancing figure should be 1,755,755. If you can just confirm whether you also get that, ladies and gentlemen, I'd appreciate that. Can you confirm for me you also get 1,755,755 as a balancing figure? Yes or no? I've lost a bit of confidence in the figures. Yes, correct. Yes. Okay. Thank you very much, ladies and gents. So that is then indeed correct. Right. So our balancing figure, and we've conceptualized it represents our contra account of bank, which in turn represents the money that we've received from our debtors as payments. That is, as soon as we write the word bank, if bank is our contra account, we know that it means there's a flow of cash, and if there is a flow of cash, it means in turn that it's a figure that we can use on the face of our statement of cash flows. So we're going to transfer that figure over to our statement of cash flows, the main body. There we go. How are we going to describe it? Cash received or cash receipts, if you wish, from customers. There we are. 1,755,755 rands. Right. Positive or negative, ladies and gentlemen? Now we really, truly talking about inflows or outflows. Is it an inflow or an outflow? Kitsa, we'll get to you just now. Thank you. Thank you, Makabongo. Thank you, everyone. It's an inflow. It's truly an inflow of cash or a source of funds, if you wish. Thank you for all those answers. So clearly we're going to show that as a positive. Yes, you wanted to ask a question there.
So why do we have sales? May you please explain again why do you have sales in the debtors T account?
Okay, why do you have sales in the debtors T account? Okay, if you think back to when you do a sale, right? This we would have done in financial accounting one last year. When you record a sale and it's a credit sale, remember the accrual system. What is the accrual system? The accrual system says you record any transaction the moment that it takes place, not when it is paid for. Right? When it is paid for is the cash system. That is what we are actually looking for now. But we are drawing up all our other financial statements on the accrual basis. And like we've just said, the accrual basis simply means you record whatever event or transaction takes place when it takes place. So if you are doing a credit sale, you are selling. So the transaction happens today, but the debtor is only going to pay you maybe in October or November, or even maybe December, depending on what the credit facilities that you supply to them. You may say they have to pay within 30 days or 60 days or 90 days, or like Edgar's within 6 months, right? Okay, so the fact remains the transaction, the sale took place today. So you are going to record it today. So if you record it, you have to go and credit your sales account, but you also have to go and debit something. What are you going to debit? You are going to debit that person or that entity that owes you the money. They owe you the money, and that person will have a little account within our accounts receivable ledger, or what we used to call the debtors ledger. There will be an individual account for that person. And the total balances and transactions of all those individuals or institutions or entities or companies that form part of your accounts receivable ledger will form part of your debtors ledger account. So at the same time, when you credit the sale, when you accrue that sale, you raise the asset. You raise the fact that the debtor owes you money. That is why it was recorded on the debtors account. Does that help? If you can just tell me, does that help, or must I do something further? I think it was Mr. Kitile. Kinda. Just go and think about it. Just go and think about it, Kitso. Also, maybe just go and listen to that part of the recording again. Otherwise, you'll have to go and revisit your financial accounting one transactions. When you make a credit sale, you credit sales and you debit debtors. Right? That is a sort of a traditional transaction, right? So as soon as you make the sale, you record the sale. But when you record the sale, you are in fact accruing the fact that a debtor owes you money. So you've got to record the asset, the amount that they owe you, as well as the income, which is the sale. Right, ladies and gents. Okay, so far so good. I actually set this session to run all the way until 20 past because I knew we were going to go a little bit over time, but I'm not probably going to go to 20 past, but I still want to complete the operating activities section. And then if Mrs. Kies will allow me next week, I will just eat probably another half an hour or so into her class. Mrs. Kies, I hope that's all right with you. Or would you rather like to have an additional class this week, students? Thank you, Mrs. Keys. No problem. Or would you prefer an additional class, or can I carry on with this next week with the other two sections?
No, you can just carry on and then I'll fall in afterwards.
Okay. Thank you, Mrs. Keys. Right, then I will a little bit into Mrs. Keys's time next week. But at least let's finish the whole operating activity section, ladies and gents. Right. So now that we've calculated the cash receipts received from customers, we can go and calculate the cash paid from suppliers and employees. So simply what we do, we take that 1755,755, our cash receipts from customers, we deduct the amount that we've previously calculated for cash generated from operations, and that will then give us our balancing figure there. I hope it does. And also clearly, ladies and gentlemen, this is truly, really an outflow of cash because it is described as cash paid to suppliers and employees. So you will show that as a negative. You will show that as a negative. Okay, so that is our operations done, ladies and gents. Maybe we'll just pause there for a little while, for a few seconds. Are there any questions on the operations part, or on the any other questions on the reconstruction of that debtors account? Doesn't seem to be. Okay, so now we can carry on to the rest of the operating activity section, which we refer to as, it's not an official term, by the way, it's just a term that we use, our so-called other operating activities. Now, we said last week there's a possibility of 5, maximum of 5 possibilities. Let's just mention them again. Your possibilities are interest received, interest paid, dividends received, and dividends paid, and income tax paid. So those are the 5 possibilities, ladies and gentlemen. Okay. Now, again, this is a new technique that we have to get used to. We are going to teach you a technique on how to calculate those cash flows, right? So our first step, when it comes, let's start with interest received, because that is normally the order that I showed in. It doesn't really matter, but I'm just saying that's what I normally do. So let's look at the interest received first. Which income, and I know we've mentioned this last week, so we just want to see whether you remember, we're still on the same page. Which income will be closely related to interest received? I think you've answered this 10 times already for me. I'm exaggerating, but many times. Interest income. Thank you all. Thank you, Magadla. Initially, Maidwa. Okay, so we are looking for something that is closely related to our interest received, so that will be our interest income. Now, our interest income, if we have any, will normally be part of our revenue note, which is part of our statement of comprehensive income. So let us go and see whether we have got any interest income. I'm going too far, and I'm going the wrong way even. Sorry about that. Have we got any interest income as part of our revenue? There, if we look at our statement of comprehensive income, ewe, yebo, right? So there it sits. Yeah, yes, revenue from interest income. And we see the revenue from interest income is 1,600 rands. But that is not necessarily the cash flow, ladies and gentlemen. And this is where you'll have to make a few notes again. This is a new technique. Once we've determined the interest income, and this is also going to form a little pattern for us, we have to go back to our statement of financial position. Why? To see whether any interest income was accrued at the beginning of the year, or whether any interest income was accrued at the end of the year, or both, right? Because if any interest income was accrued at the beginning of the year or the end of the year, or both, it means there will be a figure in our statement of financial position called either interest receivable or something like that, right? Probably interest receivable. So it is a necessary step, ladies and gentlemen. So we go to our current assets. Is there anything there in our current assets, or even our current liabilities, which will not affect our interest income. Is there anything that seems to indicate interest receivable or something that indicates that interest was accrued? Yes or no? No, nothing in this case. Thank you so much. So there's no figure under our current assets that indicates that any interest was accrued at the beginning or end of the year or both. Right. So what does that mean, ladies and gentlemen? If no interest was accrued at the beginning or end of the year, what does that mean? It means all of the interest income has actually been received during this same financial year. Does that make sense? If nothing had been accrued at the beginning or end of the year, it means all of that income, the interest income, was actually also received during the course of this year, right? So therefore, there is no account, there is no so-called balance sheet account for us to go and reconstruct, right? Nothing was accrued. So therefore, we can simply take that figure over. So that saves us a little bit of effort there. So let us just go again there. The figure was 1,600 interest income. We say that is also the amount, coincidentally, that was received with regards to interest income. So we can take that 1,600 to the face of our statement of cash flows. Voila, there it is, right? So interest received, the only difference now, we don't call it interest income because this really is the cash that landed in our bank account because of interest income. So that is our interest received. And as soon as we write anything, any figure in our statement of cash flows, we've got to ask ourselves the same question we've asked up there. Is that an inflow or outflow of cash? Inflow or outflow? Inflow. Thank you, Nkubile. Right. It's an inflow. And remember, when we are talking, thank you all, when we are talking about the direct method on the face of our statement of cash flows, this really, truly is inflows or outflows, right? It's not like it is. That is their very nature. So it is an inflow of cash, and that inflow of cash is 1,600 rands. Right, ladies and gentlemen. Then some accountants would do their dividends received next. So we can just go through the process. So if we look at our statement of comprehensive income under our revenue, hi Kit Kat, sorry, my cat just walked in and he's talking, he's looking for food, obviously, again. She's distracted me. What was I looking? Oh yeah, I was looking at the statement of comprehensive income. Is there any dividend income? Any dividend income amongst our revenues there? Yes or no? Any dividend income there amongst our revenue? No, 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 no. Thank you, ladies and gents. So if there's no dividend income, it is not impossible. It is not impossible that there could have been dividends received. But how will we determine that? How will we determine there whether there's possibly dividends received? Even though there's no dividend income, we again have to go and scrutinize our statement of financial position. So if we scrutinize our statement of financial position, do we see any item here that relates to dividends receivable? Dividends receivable. Yes or no? Any dividends receivable at the beginning of the year? No. Thank you. No, no, no. So if there's no dividends receivable at the beginning of the year and there's no dividend income, then it means it's impossible for us to then have received dividends, right? We can only receive dividends if we either had income, dividend income this year, or there was dividend income last year that we haven't received yet, that was accrued at the beginning of the year, that we actually received this year. So if there's no dividends receivable and there's no dividend income, then we cannot have received dividends either. Okay. Let's go to the next one, ladies and gentlemen. The next possibility is our interest paid. So interest paid. To which expense would our interest paid, that one there, to which expense would that be closely related? Let's use this time the wording that we find was in this finance cost. Thank you, Apiwe. Exactly. Great. Right, so finance cost, that is the expense that is closely related to our interest received. So now, first of all, this is our technique. Remember, we are forming a pattern again. This is our technique. So we go to our statement of comprehensive income. We see whether there is either any interest expense or the correct way to disclose it. Now, I've gone the wrong way again. Sorry about that. Would be finance cost. There we go. Finance cost 68,134 rands. Right. So that is our finance cost. So it will, in all probability, result in a cash flow. But that's not necessarily the interest paid. We have to go and see whether we didn't accrue any interest paid at the end or beginning of the year. So this is our technique, ladies and gentlemen. We go up to our statement of comprehensive rephrase, our statement of financial position. We see, is there anywhere under our current assets, unlikely, or under our current liabilities, quite likely, where it indicates interest payable? Interest payable. Yes or no? No, thank you very much. So nowhere, not this year, not last year. So at the beginning of the year, there was no accrual for interest payable. At the end of the year, there's no accrual for interest payable. What does that mean? It means that entire figure for interest expense was actually also paid during the course of the year, right? There's no accrual at the beginning or end of the year, so it means that the entire amount, there we go, of our finance cost was actually paid during the course of the year. So we can take that figure of 68,134, we transfer it over to our statement of cash flows. There, oops, too far. There we go. Interest paid 68,134. And as we've said previously, the minute, the second, the moment when you write any figure in your statement of cash flows or any other statement for that matter, you've got to ask yourselves, in this case of a statement of cash flows, is that an inflow or outflow of cash? And you can type for me. Outflow. Thank you, all right. Thank you, Inga. Thank you, Mbuso. And thank you, Langa. Thank you, Ms. Sujini. Right. I think it's Rita, actually, if I remember correctly. Rita Sujini. Comes back to me now slowly but surely. Okay, so I'll call you Rita in future. If I'm correct. If I'm not correct, you must correct me. Okay, ladies and gentlemen, so it is an outflow. So we are going to show it as a negative, right? We're going to show it as a negative. Now we've still got two possibilities left. We've covered the first three possibilities. Still got two possibilities left. Our dividends paid, correct? Thank you. I thought so. It took me a while, but I eventually remembered. Thanks, Rita. So dividends paid, ladies and gentlemen. So now we will have to go and see, were there any dividends declared during the course of the year? Now, I'm very glad that I set this class to go until 20 past. I'm sorry for going over time, but I did expect it, because it's almost impossible to discuss such a question in 2 hours. Anyway, so now let's go to our statement of changes in equity, right? That is where we will find dividends declared. So, ladies and gentlemen, we go to our statement of changes in equity. We see there's ordinary dividends declared of 112,500 rands. There's preference dividends declared of 12,500 rands, right? So our total dividends declared, if I calculate correctly in my head, please correct me if I'm wrong, looks to be 125,000, right? So our total dividends declared are 125,000. 100. Thank you, Apiwe, for confirming that. So now we've still got to, that's still not necessarily the cash flow. That is what was declared. So like we've seen earlier, we've got this technique that we've designed for ourselves now, that we go and we scrutinize our statement of financial position. We scrutinize our statement of financial position amongst our current assets, very unlikely, and amongst our current liabilities, very possible. Is there any dividends accrued at the beginning of the year or at the end of the year, or both? Yes or no? Now you must remember, ladies and gentlemen, how did we describe it? Thank you, Nkobile. How did we describe it? Thank you, Langa. How did we describe it when we did share capital? We said when we raise the liability, when we declare the dividend and we raise the liability, we're going to credit shareholders, right? And that asterisk also tells you, they say there actually as a note, which wasn't necessary, but they did, very kind of them. Shareholders, thank you, Rita. So they're saying there this amount, shareholders, represents the dividends owed to ordinary and preference shareholders for dividends, right? So we see there was an accrual at the beginning of the year of 62,500. There's also an accrual at the end of the year of 75,000, which means, ladies and gentlemen, that all of those dividends declared was not necessarily paid. We could have received some of the dividends that we accrued at the end of last year, in other words, at the beginning of the year, and clearly those dividends that we've declared this year that we haven't paid by the end of the year yet is also sitting there, that 75,000. That means, ladies and gentlemen, the implication of that is that we have to go and reconstruct that account. Why? We said it earlier with debtors, because on that account, the accrual took place when we declared the dividends, we accrued it there. But similarly, on that same account, we are going to record the movement of cash. When we pay the shareholders their dividends, we're also going to record it there. In other words, we're going to credit bank and we're going to debit shareholders. When we declare the dividend, we're going to debit dividends declared, whichever of those two classes, and credit shareholders. When we make the payment, we're going to debit the shareholders, the other side of the coin, and credit the bank account. Okay, so we have to go and reconstruct that account, ladies and gentlemen. Now, there are two ways to determine whether this opening balance is a debit or a credit. Simply, if you look at it, it's an amount that you owe to your shareholders. So that indicates that the balance, the opening balance, will be a debit or credit. A credit, thank you, Mbuso. Thank you, Asim Masli. Right, it's a liability, right? So you can either look at it from the perspective that you owe the money, that indicates a credit, or you can simply see for yourselves that it is indicated under current liabilities. And liabilities, we know they have credit balances, right? So our opening balance at the beginning of the year is going to be a credit balance of 62,500. Let me just undo that. Whatever I've done, let me undo it. Oops, I made a little boo-boo there. Where is it now? There we go. So our opening balance there would be 62,500 credit at the beginning of the year, and at the beginning of the following year, the next year, it will still be a credit balance of 75,000, right? At the beginning of the next year, it will also be a credit balance. So now we're going to reconstruct that shareholders account. So let's go and find it amongst our reconstructions. It's on the last page of this little document. There we go. There's our shareholders account, ladies and gentlemen. So there we've got a credit balance at the beginning of the year, 62,500. At the beginning of the next financial year, we've also got a credit balance of 75,000 rands, ladies and gentlemen. And now that little part where you are going to hear my voice in your heads when you are doing these reconstructions, how does that little rhyme goes? Where does that credit 75,000 come from? From the opposite side above the line, because now we are working backwards. We are working in reverse. Originally, when we drew up this account, we would have done it chronological order, chronologically, right? Now we're working backwards. So that 75,000 credit balance comes from the opposite side above the line, where it was a closing balance that was carried forward. The other figure that we can find in our statement of changes in equity, we've already seen that it is a total of 125,000 when we would have accrued the dividends that were declared. We would have debited dividends declared, and we would have credited, we would have raised the liability towards our shareholders, right? So we would have credited this shareholders account. Now we've only got one outstanding figure, ladies and gentlemen. We've already conceptualized in our heads what it represents. It represents the payment of those dividends that we've declared, right? Either now or previously, it represents the payment. So we can already see that our contra account is going to be the bank account. And if our contra account is the bank account, it means it represents the flow of cash. And if it represents the flow of cash, it means it is an item that we have to disclose on the face of our statement of cash flows when we are using the direct method. So now we can go and balance this account off. So we add the 62,500 plus the 125,000 rands, ladies and gentlemen. That should then give us 187,500. We copy that total over from the larger side to the smaller side. We copy it over. We deduct that balance carried forward, and we see that our balancing figure for this account, which we said last week, a ledger account is just an equation. It's a mathematical equation. So we see that our balancing figure is 112,500. Hopefully that is correct, right? We simply take that figure, transfer it over to our statement of cash flows. We transfer it to our statement of cash flows. That will represent, going the wrong way, that will represent our dividends paid. So there we go. Dividends paid, the amount 112,500, right? Is it an inflow or outflow of cash? If we pay dividends, money flows from our bank account. Thank you, Nkobile. It's an outflow. Thank you, Asemasle. It's an outflow of cash, right? So therefore, we are going to show it in brackets. We're going to show it in brackets. Right, thanks for that, Milton and Bonga and Rita, Janita, and I've already mentioned Nkobile and Asemasle. Okay. Right, so there's one left, ladies and gentlemen. No, we're running, we already run out of time, but we are just going to carry on. I'd just like to finish this section. Is that okay with you? Just give me a thumbs up or a thumbs down. If it's a thumbs down, we'll do it next Monday. If it's a thumbs up, we finish it now. My thumbs are both up. Or you can just say yes or no. Okay, I'm wasting time. Let's carry on unless there are thumbs downs. Yes, thank you, Tembisa. Let us carry on. Right. So our next item, ladies and gentlemen, our next item that we have to look at is our income tax paid. Our income tax paid. So, ladies and gentlemen, we now have a technique. We've designed this technique for ourselves. First of all, we're going to see, is there an expense that is closely related to it? You've already answered that question last week. The expense that is closely related to this cash flow is our income tax expense. And we know that the income tax expense can be found on, thank you there, thank you, Apiwe. Yes, the income tax expense can be found on the face of our statement of comprehensive income. So we go up to our statement of comprehensive income. There we go. And we see there our income tax expense for the year was 88,944 rands. But that is not necessarily what we paid. That is the amount for the expense that we've accrued at the end of the year when we drew up these financial statements. But we are looking for the amounts that we paid to the Revenue Service, which will in all probability be, if you remember back to the second term, our first provisional tax payment, our second provisional tax payment, and possibly another top-up payment for the previous year if we had underpaid. Right. Okay, so what we need to do now, once we've determined that there is such an expense, and there we see it clearly, we take the figure, but now we've still got to go and scrutinize our statement of financial position to see whether there was any income tax accrued at the beginning of the year or at the end of the year or both. So, ladies and gentlemen, have we accrued any income tax expense at the beginning of the end of the year? Yes or no? Have we accrued any? Yes, thank you, Rita. Thank you, Apiwe. Thank you, Langa. Thank you, Milton and Bonga and Nkubile and Simamkele. All of you are correct. There we can see it at the beginning of the year. At the beginning of the year, we had current tax refundable under our current assets for income tax. But at the end of the year, so this is a little bit tricky. At the end of the year, that balance is zero. But, big but, but under our current liabilities, we now have got current tax payable for income tax, right? So at the beginning of the year, if it's under current assets, it would have had a debit or a credit balance, ladies and gentlemen, at the beginning of the year, where it is under our current assets. A debit, thank you, Apiwe, right? It would have had a debit, thank you, Nkubile. At the end of the year, however, where it sits under current liabilities, would that therefore be a credit or a debit balance at the beginning of the next year? A credit, thank you, Apiwe and Nkubile and Rita. Right, ladies and gentlemen, there we go. Thank you, Bonga. So a credit at the beginning of the next year. So now we must know it works a little bit different between the 2 years. So we're going to take our current tax there. Our current tax refundable, which is under current assets, that will be an opening balance for this year on the debit side. And then for the next year, we'll have an opening balance for the next year under the credit side of 6,444 rands. Right. So let's go and put that into our T account that we are reconstructing. So we are looking for current tax payable or receivable. Let's see where we find that. There we go. Current tax payable or current tax receivable. So at the beginning of the year, we said it was a debit balance of 3,220 because it was residing under current assets. So they owed us a refund in income tax, right? They owed us. It was actually called income tax refundable. or current tax refundable for income tax, right? So that's the debit balance. But then the beginning of the year balance for next year, that was under our current liabilities, ladies and gentlemen. So that means that is sitting here. What was that balance again? Was it, let me just go up again. I think there's a little error in that account. Current tax payable was 6444. 6444. That account seems to be incorrect. Let me just go and look at that. Sorry about that. Let me just see if we haven't done another one that is correct. It might have been duplicated. Let me just have a look. No, it's not there. It's not there. No, we'll have to simply have to go and correct this. Okay, so oh, there it is. There is the balance. I see what's the problem. Those two. Okay, let me just correct this account, ladies and gentlemen. Let me just correct this account. Just cut. Sorry about that. And that was the total. Sorry about that. Sorry about that. Sorry about that. And this must also be going down. Oops. Now I've just wasted so much of our precious time. I'm so sorry. Okay, that looks a little bit better. Okay, so our balance at the beginning of the year, that 6444 is a credit, isn't it?
It's on the credit side. I think actually
Yes.
it was correct.
I think it wasn't, if I remember correctly. But anyway,
it was on the debit side, which was correct above the line. It was just that it wasn't brought down, and perhaps that's what was confusing. That 6444 was above the line on the debit side, so brought down on the credit side, but it wasn't brought down. That was the only only problem.
Right, I think I see what you mean. Okay, I'm so sorry about that. No, that's not the figure I'm looking for. No, that's not the figure. I've got to put it in here. Right, and that was a balance. Okay, something like that. Okay, now I don't want that bolded. Mrs. Kies, does that look okay now?
Yeah, actually it was like that, except for it was not brought down on the credits.
Yeah, the main thing is that figure was actually in the totals block.
Yeah, but it was not really. It was actually correct as it was. But it's correct now. It's correct now. You must just delete the balance brought down here on the or carry down on the debit side.
Yes.
Yeah, that's it.
There we go. Okay, right, ladies and gents. So there we've got our opening balance on the debit side because it was under current assets. Thank you so much, Mrs. Kies. We've got the opening balance for the next year under the credit as a credit balance because it fell under our current liabilities. Where does that credit balance come from? It comes from the opposite side above the line. So there you've got my voice in your head, hopefully. So now it's just a matter of going to balance off this account, or we must still get our tax expense, which we've already carried forward from our statement of comprehensive income. You can just maybe go there quickly again. So there was our income tax expense. Just as a reminder, 68,944. So when we accrued that, we would have debited the income tax expense. We would have credited our current tax payable. Right, so there it is. Now we simply go and balance this account off. So we add up the largest side, which is this side. It adds up to 88,944. We copy that total over to the opposite side, 88,944. We deduct the 3270. We deduct the 6444. That gives us a balancing figure of that. And we've already conceptualized that that can only represent the payments that we've made to our revenue services, right? Whichever revenue services we are dealing with. So our contra entry would be the bank account. So that would represent the flow of funds. So 79,280. We go to our face of our statement of cash flows. There we go. Income tax paid. That is how we describe it. 79,280. And clearly, ladies and gentlemen, it's something that we have paid. So it will be an outflow of cash. Therefore, we're going to show it as a negative. Okay, so now we are done with the whole cash flows from operating activities. All that remains is we just add up that subtotal, and we add up all these positives and all these negatives, and we get another subtotal for this whole section, the cash flows from operating activities, the whole section of 84,766. Right, we need a subtotal there. We'll talk about that again next time. My apologies again for going so much over time, but we actually got more or less where I expected us to. Thank you, Mrs. Keys. You're welcome. Thank you. Okay, students, you may all leave now. Thank you for attending. We'll speak again next week, Monday, ESCOM permitting. We will. I will just finish this question, and then Mrs. Keys will carry on. Have a lovely afternoon. Thank you very much. Bye bye.